Anyone with any question? One of the things I want to add here is the beauty of this system here is you don't need property management. The tenant owner is taking care of it. They can paint the house, they can do anything, they can improve it, they can put a deck out there. There are many things that they are free to do. Some of this rent to own I see because the owner stay owner till 3 years. There's a little bit of difference here is that they are paying the tax themselves. So we have a little bit of variation there that I've seen in the past.
Yes.
All right. Now I'm going to ask if there's anyone has any question. I'm trying to find my chat.
I have a question actually, Ash.
Sure, go ahead.
So Matthew, so you said you were saying like they're buying the property at a future purchase price, but how are they going to get money how is the bank going to give them money on a property that they're not even sure it's going to appreciate in value in 3 years time? Does that make sense? So like you go into the bank to say, I need a mortgage loan of 290, but you're buying the property for now.
Okay, so basically the investor who has the money, he's buying the property for today's price at 250. So the bank gives money for a price today at 250 and the property will get appraised, right? So that's how the bank knows the value today. Now, the tenant buyer is not buying the house today. They are going into a purchase and sale agreement that closes in 3 years from now.
Okay, now I get it.
So I can do a purchase and sale agreement where I'm closing in 3 months and I buy the house for 250 within 3 months. And I could enter into a purchase and sale agreement where the closing is not in 3 months, the closing is in 3 years. So they don't have to take that document to the bank to buy that property or qualify for it until 3 years from now. And what they're hoping 3 years from now is that the property has met that value and actually superseded that value. And if it has met the value and superseded it, now they feel a lot better 3 years from now when they actually go to the bank. So they don't buy it now. The investor buys it now and then puts the person in who signs an agreement right now to close in 3 years. And 3 years from now, they go to the bank and they get qualified 3 years from now. Does that sort of answer the question?
Yeah, that's fine.
I have two questions on behalf of one of our audience here. Question number one, this is the question they asked. Why would one doesn't want to buy the property right now rather than waiting 3 to 5 years?
Well, the reason why they can't buy now is one of these reasons right here. Because their credit is damaged and they can't qualify for a mortgage right now. It might take them 3 to 5 years to qualify. Or maybe they're self-employed and they have no income to show because they're expensing everything away. Or maybe they have a new job and they can't qualify for that house today. So therefore they have to wait 3 years. Now keep this in mind. It's a 3-year contract. You could create an open 3-year contract, which means they don't have to wait 3 years to buy it. They can buy it anywhere along that track. In other words, in 1 year, 2 years, or 3 years, once they're in a better position. But another reason why they're not buying it today is because maybe they have a bankruptcy, which takes a number of years to clear. Maybe it takes 7 years to clear, and they got 3 more years to clear that bankruptcy. Maybe they can't save money. They want to tie their money up in your hands so they don't spend it. Some people gamble, some people drink. You know, one thing I know about wealth is some people who get a lot of wealth, they don't know how to manage it. And if you're a gambler, you can afford to gamble now. If you're a drinker, you can afford to drink. And whatever your vice is, you can afford to do it. And some people who used to rent to own for me, they just want me to tie their money up for them because they know they'll spend it. You might be new to the country and you can't get a mortgage right now. And you may want to just try out a neighborhood. So these are the reasons why the person cannot buy the house today. Because if they could, they would, and they wouldn't go through all this hassle. So hopefully that answers the question.
Actually, Matthew, sorry to
I have a question. Can you guys hear me?
Sure. Yes.
Okay. I have a question. With regards to the market going up like more than 6% every year now, it's like almost at 12%. How do you know, like if you're saying that if somebody's going to buy, most of the homes in Ontario are around 400,000. So in, let's say 3 years from now, the person that is going to be buying it needs to qualify possibly at 5 or 6. How do, like, what if they're not able to qualify at that price point, because in 3 years they have, like, they're still saving, but it's just the property's value has like increased, and based on the bank appraising it or you guys coming to an agreement, I'm just trying to figure out, like, with the climate of real estate, how do you, like the purchase price in 3 years might go up like 200,000. And
Okay.
so as an investor purchasing, wouldn't you want to be like, if I'm buying something for 4, would you be like, okay, let's buy it for 6, or let's see if you can qualify for 6?
Okay, basically the future price is locked in today. Okay, which means if the house is purchased today for 400,000 and I'm putting you into it to rent to own from me, today we have to guess at the future price and we have to lock that in. Okay, which means if we guess the price is going to be $100,000 more, 500,000, then it's locked in. Now, if in fact, if the price goes to less than 500,000, you're going to have to buy a property more expensive, and you'll have to find some bridge money to help you make up that amount. If the property goes past 500,000, if it goes to 600,000, now you're happy because you're buying a house for 500,000 that is worth 6. As the seller, I'm not so happy because I sold you a house for 500,000 3 years from now, which I could have got an extra $100,000 from. So it's a guess. You have to look at what's happened in the past. You have to look at what's coming to the area. You have to look at the situation and try to figure out, where do you think it's going to be? So nobody knows for sure where it's going to be. You just have to
So
take.
do you do it based on like a 6% evaluation per year, or is it more than that? Because let's say, I don't know if you invest in Toronto, most rent to own investors I know like are outside or even in different provinces, because the inflation is just so crazy that sometimes the buyer, it doesn't make sense because they don't know if the buyers are going to be able to qualify unless I guess you have to get a really good buyer. But is there a set formula that you go by, like a percentage, like you don't go over a certain percentage of evaluation for 3 years from now?
Okay, so
guessing that number.
So here's what I do. You cannot predict the future from the past, but the past is a good indication of what could happen. So if for the last 3 years, properties have been appreciating 10% a year, I want to consider that. That if it's been 10% a year, I can probably project it'll be 10% a year for the next 3 years. But that is hard to convince somebody because, well, you can't predict the future. So then from the 10% a year, you're gonna have to bring it down to what you think you can convince somebody of. Now, if there happens to be a subway station going into that area, and there happens to be something great business-wise happening there, then I can justify to the person who was buying that, hey, it's 10% a year, but I think that is real. In fact, I'll drop it to about 8% a year, but I can justify 8 to 10 because of what's happening in the area. Now, at the same time, if it's been 10% a year, and then all of a sudden I see, companies leaving an area, or there's bad news happening, then it's going to be hard to convince somebody that it's going to be 10% a year. So you may have to fall back to 6% a year. So it's going to be what you can convince them to do based on some facts of the area, and also what is affordable to them. You don't want them to end up losing the house. I mean, it still becomes yours. It's still yours, and you still get to rent it out to somebody else. But you don't want to create that bad blood in the community where you're the master of people never closing on the deal, right?
Yeah,
So,
that's true.
so there is no set formula. It is a combination of what has happened, what is happening in the area, what can you justify, and the last point is, how important is it to them? Like, for instance, if they're 1 block away from work, as opposed to right now, they drive an hour and a half to work. If they're really close to their parents and their parents are senior, one of them has early onset dementia, and they want to be next to that person, as opposed to be an hour away, then you know what? That 6% becomes an 8%. They'll pay for their convenience, not always the math. So it depends on their situation. It also depends on the investor situation. What do I need? because I'm taking a risk to buy that house also. But I'm taking a risk that the price we agree upon is not going to be too low for the future. So I also risk as well. So it's a combination of those 3 or 4 things. So it's not a set formula. It's just taking about 5 or 6 things together to try to come up with a reasonable argument that you can pose that would make sense. And if after 3 years they cannot qualify because the property is too high or they have not so good credit still, nothing stops you from giving them a 1-year extension. So you can just rework an extension and give them that 1 year if you want, and that gives them a shot to get in there. So that might be a possibility. Lastly, if there's a small bit they need to make up, and if you have some good equity in that property because you put more than 20% down when you initially bought it, let's say you put 40% down, then you might be able to give them some paper, which means if they can't buy it in 3 years for the set price, they can't make up that much mortgage, there's a gap, then you can give them a VTB, which means they'll be paying you.
That's what I was going to ask. That's my second question.
Yeah.
Thank you.
Yeah. So it all depends on the scenario.
Matthew, I have a question, actually. It's a follow-up to this, the answer you just gave. So I'm just trying to wrap my head around this strategy. So if I were to buy a property today, and let's say I was not wanting to speculate on a price of that property 3 to 5 years from now, why wouldn't I just avoid this sort of environment and just let the true appreciation speak for itself in 5 years if I'm willing, if I'm looking to get out in 5 years' time? So I guess what I'm trying to understand is, if I'm speculating on a price in 3 to 5 years and I'm wrong, I've just undervalued my investment. If I'm right and the market dips, well, of course, the tenant probably is not going to be as motivated to buy, being that the property is now depreciated and the set price is not the true price of the property at the time. So isn't there a bit of a gamble there? And how do I, as an investor, which is again another question, how do I let them decide on the home that they wish to buy? Because as an experienced investor, I know what to look for. They might be just looking, as you said earlier, they just want to be beside their niece or their sister, and that might mean that the property is not as advantageous as an investment as they see it. And I'm left with the investment if they renege, or if they can't make good on the payment. So maybe you can answer those questions for us.
Okay, I'll answer the second part first. Yes, they get to choose a house, but your common sense and your skill set can't go out the door, which means if they choose something that does not make sense mathematically for me, I'm not going to buy it. At the same time, if the house is in disarray, I'm not going to buy it. If the inspection doesn't come back, the appraisal doesn't come back, I'm not going to give them exactly what they want. So again, I'll say go find something within this range, but if they find me something that I don't want to buy, then I'm not going to buy it. So first and foremost, it is true. As investors, we have to put our pegs in so we don't fall too far. So no one's going to force me or you to buy a house that's not a good house. So keep that in mind, okay? Number two, sometimes when you look at a property, and let's say that it's costing you, we'll keep it simple, $1,500 to carry the house. So you buy a house, it costs you $1,500 to carry. But let's say that the only rent you can get is $1,200. So right now you're underwater. You're underwater by $300 a month, okay? Now you may say, okay, I'm gonna be on $300 a month under for the next 3 years. Hopefully the value will go up, but I'm gonna be losing $300 a month. By putting somebody in a rent-to-own scenario, they're paying the regular $1,200, but they're also paying a portion above the $1,200 to go into, let's say, their future savings. Let's pretend that portion is $500. So now you're getting $1,700 in. Keep in mind, $1,200 technically is rent, and $500 is accounts payable. You owe them that money. Now, they never get it back because when they buy the house, it just comes off the price. But it is an accounts payable. So therefore, it's not something you pay tax on because you owe it to them. Got that? Number one. Number two, all of a sudden, you're getting $1,700 in, whereas you're getting $1,200. So before you're getting $1,200, losing $3, now you're getting 17. The 12 you're getting plus the 500, you're getting 17. So now you're in a better situation because your 1,500 a month, which was your expenses, versus your 1,200 coming in, left you -3. Now you're still getting in 15, you're still paying out 1,500, but you're receiving 1,700. And of the 17, 12 is rent and 5 is a credit towards rent. So now you're in a positive cash flow. Plus, I don't want to call it cash flow. You're in a positive situation. And I can't call it cash flow because technically that extra $500 is an accounts payable. You owe it to them, which they never get back. If they break the lease and walk away, they don't get it back. They buy the house, it just comes off the future price. Another thing is this: if you're paying $1,500 and you're only receiving $1,200 as rent, maybe some of that $1,500 is expenses that the person who is renting to own takes over, because they're covering, most likely they have to pay for their own insurance. They're paying all utilities now. They're paying, or they're taking care of the grass and everything else, so no property management for you anymore. And at the same time, they're taking better care of the property, so it's breaking down less. So that $1,500 that you were putting out before, maybe that comes down to $1,350 now, or maybe even $1,300. So the $1,200 rent plus the extra, $500, and your expenses have just come down a bit, that's a positive for you as well. So to answer your question, if you're in a tough situation where you're making negative cash flow and you can't carry it, it's good to get into a rent to own, which will boost the money coming into your pocket. Does that answer your question, or did I go too long on that?
No, you did, in fact. So what I'm understanding is this strategy is best for individuals or investors that perhaps cannot handle a negative cash flow environment. Or
somebody who wants, or let's say $1,500 a month is what's going out, and you're getting $1,600 coming in. So your cash flow is $100. Remember, you're putting out $1,500, but your rent is $1,600. So you're making about $100 a month cash flow. And let's say you want more cash flow, because the purpose of buying this house was to pay for your Camry, which is $450 a month. I'm just making up a car, right? And this cash flow is not covering the Camry. So maybe you need an extra $350. So therefore you put it into a lease option, and all of a sudden now you're getting an extra $500, extra $400. It takes your $100 cash flow coming in, plus the additional portion, the $400 extra, which is accounts payable, but it's still money that's cash in your pocket. It boosts your cash in pocket. Now, keep in mind that people buy properties for, to generate cash flow and do different things. I've always been purpose driven. If I want a car, let's say I want to pay, $1,000 for a car a month, I'll do a real estate deal to pay for that. Or if I need to, pay for my house and I need to pay a mortgage of $2,500 a month, let's just say, I'll probably do 2 deals in order to pay for that. So I'm more purpose driven. In other words, everything that I spend money on, I create a machine to generate the money for. And that machine might be, I bought the house to pay for my car, but I'm only positive cash flow 100. Maybe I need $400 more to pay for that. Or maybe I bought the house to put money away for my daughter to go to school. And maybe my cash flow is only 100 and I need $300 more, $400 more to put it into something to go towards her schooling. So some people have a purpose-driven way of doing things. So it's not just for low cash flow. It's for if you're making positive cash flow, but you want a bit more money in your pocket today.
Right. But I guess, and I don't mean to pile on here, but the actual appreciation speculation is the concern, because even though the trade-off might be we want extra cash flow today, if I undervalue the property in 3 years, because as the last individual said, if you're investing in a property within the GTA and we speculate it to be 8% and it certainly appreciates 15%, well, I think I've done a disservice to myself. Have I not in 3 years?
But what makes you think you have to be so conservative?
I don't know. I mean, I'm sitting across the table from someone who's somewhat naive in terms of what property values would be in 3 years or 5 years time. I can't imagine that individual who is a real estate savvy investor would be coming to me looking to have me buy their home. So they're probably somewhat naive. I have to then convince them that the property is going to be worth what past performance is, which is no indication that it's going to be accurate. So we could speculate that it's going to be, let's say, you use 250. That's a number, of course, I would never see in the GTA. But let's say we're looking at a 500,000 or 600,000 condo, and we were to say that in 3 years or 5 years time, we anticipate it to be worth 750. I have to convince that individual, or you have to convince that individual that that property is going to appreciate 150,000 or 200,000. I don't know if that's going to be a challenge in itself, but if it's not, and the person is convinced that it will be worth as such, and the property is now worth 850 in that 5 years time or 3 years time, I've accomplished the immediate cash flow concern, like you discussed, the extra or the additional cash flow, but now I've walked away from the true appreciation value in that 5 years, or I've lost the additional whatever the market value is at the time. So I guess not to sort of discredit what you're saying, but I'm just trying to understand, why would somebody go this route? And if they do go this route, what is the protection to the investor?
Okay, first of all, you cannot discredit what I'm saying because I do this for a living.
No, I'm not trying to.
I know, but I want to be straightforward with you. If you believe something or not, it doesn't matter. It's happening anyway. So keep that in mind.
Sure.
I say that to you from a kind way. Now, here's the other aspect of it. Right now, you're thinking logically. You're sitting across the table from somebody who is in a tough situation, and they do not think logically. They want something today for today. You know what I mean? And therefore, even if I can show on paper that 10% is the most it'll ever go, these people will still accept 15% higher, not because they're not savvy, because they're more desperate. And they're more desperate to get their people in the right position today for today. Now, I'm not taking advantage of desperate people, but I'm just trying to say to you, when you're sitting across the table, it is not so hard to negotiate as you're speculating, because these people have a real need. Let me give an example. I have guys right now from China, not now, but let's say a few years ago. They buy 10 condos downtown Toronto. And these condos can be $500,000 a piece. And they keep them empty. And they keep them empty because they just don't really care to deal with tenants. Now, why would you dump $500,000 times 10? Who's going to dump $5 million into condos and pay a condo fee of $500 a month, $6,000 a year, times 10, $60,000, and keep them empty? It's not logical. It's not rational. But if your money's tied up in China, and to be wealthy in China means you have to jump through a few hoops, and those hoops are created so that the government can take your money, because you have to jump through those hoops they created, and you could lose that $5 million like this, well then to put $5 million in Toronto and lose $60,000 a year per condo in order just to save your $5 million, that makes sense. So I give you that big long answer to say to you, it's not a rational thing where someone's sitting across the table saying that logically I can do this, logically I can do that. They have a desperate need, and that's why they've come to you. You're trying to be fair with them, but you can predict even more than it's worth to protect yourself. And in most cases, they don't care. They'll go for it anyway. And I try to keep them within reason so that they don't overbite. You know what I mean? So it's not as hard as a conversation, because they are in a more desperate situation. It could be a desperate good situation. Like they're so excited to move, 1 block away from their girlfriend because they hate having to drive an hour and a half to Kitchener, and they're about to lose their girlfriend. They don't mind paying a few extra dollars for these things. I know it sounds kind of silly, but people have things that are important to them, and they look at the extra prediction of the future, and they don't care as much. Like Alfonso's done 100 plus of these things. I've probably done in my life maybe about 30 of them. So I'm not a person who's done 100 or so. But looking back to my 30 that I've done, people sit across the table and they just want the deal. They're so distraught that no one's helping them, no one's financing them. They're just sick and tired of living in a tough or bad area or some situation that's in their life. They just need to get away from that. So you can go higher so that you don't sell yourself short. But yes, there is a gamble. And the gamble is it can go higher than you're selling it for, or it can go less than you're selling it for. Either way, there's a gamble, and that's true.
So can I, as the investor, renege on the contract if the?
No, you cannot. You are locked into a deal. Yes.
They can. So I'm locked. They're not.
Well, that's right. So that's a very astute observation. You are locked in that deal. You have to sell to them. If they respect the rules where they pay the down payment and they give you payments on time, then pretty much you cannot walk away from them. They have the option to walk away from you. if they walk away from you, all the down payment money to date and all the portion above the rent to date can be lost to them. It stays with you. You have a choice. If you felt like it, you can do something for them. You can give it back to them. I wouldn't, because I had to gamble as well. You can, give a portion of it back if it makes you feel better. But the fact is, they win, you win, you can both win if you can predict the future. But there is that hole right there, which I think you're seeing, that nobody knows the future. So it could go up, it can go down, but at least you give them a shot of it and they get out of a situation. Now, I will say this to you. Remember that I said I did about 30 of these? I would probably say about 40% of them failed, which means only 60% of them went through. 40% failed, people did not get the house. And of the 40%, I would say 50% of those chose not to continue and to lose a deposit. Because when they got into it, their life was horrible. They were on the high seas. Their ship was getting battered around, beaten around in the high seas. I put them in this house. They're in harbor for 3 years. 2 years downrange, now their life is better. And they say to me, you know what? The price you're offering me to buy this property for, I can get a better deal. So 2 years in, because they're in harbor now, because they're safe, because I let them be somewhere they want to be, and they can pull their life together again, I'm kind of helping them manage their life with their finances. They turn to me and they say to me, I want to break the lease. I can get better. I didn't think I could, but I can. And I can build something or buy something a lot cheaper than I think of what you're selling it to me for. So I'm breaking the lease. I'm going to walk away. See you later. And they leave me. I felt like I've been left. But 20% of the time when people break away, it's not because they couldn't afford it. It's because I let them get a chance to get their lives in a better position. And they walk away on their own. And 60% of the time, they finished. And of the 60% of the time, I would say I was higher than the area of the 60%. I would say I was higher by 50% than the area, and I was lower by 50%. And when I say higher and lower, I'm talking about maybe I was 25K higher or 25K lower. It wasn't hundreds of thousands of dollars, But I will give a caveat. I did do this in a time where things were appreciating 5 and 6% a year, but it wasn't crazy like 15, 20% and all that kind of stuff. So it was a bit easier back then. And it was always markets were going up when I did it, as opposed to we're the top of the market and it could fall. I find it very difficult to convince people when they felt as though the market was going to fall. So as long as the market was driving forward, that was easier for me. So,
sorry, Mathew.
Yeah, go ahead.
Thank you very much. I appreciate the answers. So one last question, and perhaps maybe it's all on everyone's mind, but now with COVID-19 and people somewhat concerned that the market may cool off somewhat or stay stagnant, how does this system now play out, even for your own, forget me, but just for yourself as an investor in this strategy? How do you navigate the future with the unknowns?
Here's my problem with COVID. The U.S. is a major player for us. We're a small market, but we depend a lot on the U.S. If the U.S. decided to behave themselves a certain way and deal with their virus, then you know what? In 4 months, things could be good. If you told me 3 months ago that 154,000 people would be dead in the U.S., I wouldn't believe that, because I knew they got pissed off when they lost about 2,600 people on September 11th. So I didn't think 154,000 dead would not be something that important to them in general, right? So in the end, because we depend on them, obviously we sell more goods to them than they buy from us, but they sell us a hell of a lot more services than we sell goods to them. So we've actually been treating them pretty good, not bad. Okay, we buy a lot more services from them than the goods we sell to them, but our goods need to go to them. And right now they're behaving bad, and half the country is in trouble. So it's very hard for me to predict the future. It all depends on if the US begins to behave themselves. And I know something about the Americans. Americans, they may play games, but when they get together, they can do amazing things. It's how much pain do they need to get together to do amazing things. Because once they get together, they'll pull themselves out of this thing very rapidly. So I suspect the market is not going to go up as much as it normally was going up, but I don't think it's going to collapse. People still need a place to live, and the world's still a horrible place. Canada is a great place to live. Everybody seems to want to come here. So because people are still coming to Canada, to me, it's all about inventory. You know, in Alberta, I have properties out there. The inventory is 9 months. It'll take 9 months to sell off all the inventory if nobody put it properly in the market. So it's not a great market. In BC, in some spots, it's actually 10 months. But in Toronto, I think it's like less than 30 days. It's like less than 20 days. I don't even know.
Oh, that's
You
right.
know, so, and then Mississauga and Brampton, the market is white hot. So as long as the inventory is low, I don't really concern myself about, you know, what's happening with the market. To me, it's all about inventory. You know, so I know it's a big long answer, but I think we're going to be more steady. I don't think we're going to fall off the edge. I think properties will continue to go up. I think because Canadians will rise to the occasion, we'll be more efficient, and we still have a great country and people want to live here. You know, and I believe the Americans will get their acts together. You know, whether you want to wear a mask or not, there's lots of reasons why somebody shouldn't or should. I just remembered, you know, I watched the movie just really quickly, Saving Private Ryan, watching what these 19-year-olds did in Canadians and even Americans, jumping off these boats, running on shore, getting machine guns shot to pieces, getting their heads blown off with machine guns. And these 19-year-olds did that for the country. And their bodies are laying in the funerals right now, in a cemetery. So, I don't know. I don't think wearing a mask in the country is a whole big issue. I think getting your head blown off is a bit harder. And I was a soldier, and I gave my time for the country. So, you know what? I think if we move together, whether you want to or not, I think it'll be okay. That's my prediction. But I'm not, you know, I'm not a not a future teller.
Great. Thank you very much, Matthew. Any other question? I have one guideline here for Luca. I think one of the way you can find out how much a property can grow in any different neighborhood in GTA is what I always bring it up here is Home Price Index. It's published once a month by Toronto Real Estate Board, TREB, and updated every single month, showing different neighborhoods, the growth they have, and that goes all the way to 10 years. So if you come across this situation with rent to own, that's one of the greatest guidelines that you can actually show it to the tenant. And based on that agreement, you can choose how much your property is going to grow in any given time, 3 years, 1 year, whatever is the term for your rent to own. Matthew, I have a quick question for you. Is your tenant with rent to own goes under Ontario Tenancy Act or no?
So technically, nothing in the agreement talks about being a tenant, but I still consider them under the act because there's not a lot of case law on it, right? So I don't call them tenants, you know, I call them occupants. There's an agreement, so it's a long form, pushes to the agreement to actually buy the property in 3 years, but they have the right to occupy the property while they're waiting to buy it, right? But you know what? Certain adjudicators can look at it and say, you're a tenant. Another adjudicator might say, you're not. It all depends on who you get. But I've not had a chance to, let's say, put it to the test, you know, in the last, let's say, 5 or 6 years. I don't do a lot of these rent to owns. When I began as an investor, I did most of them because I spent all my time now in the commercial world, the multifamily world, and building. I can't say that I've taken anybody to the tribunal on this for the last 8 years. But somebody like Alfonso on the screen, he would be able to answer that question like right away because I'm sure he deals with stuff like that.
Yep.
you know. But again, we try not to say the word tenant, but, you know, still consider them in the Tenant Act. Anyway.
Excellent. Any other questions? Perfect. Well, thank you, Matthew, for coming and tell us more about rent to own. It's a great pleasure to have you here. And I think everybody here learned about this strategy, and hopefully some of us would use this information and get into the market for rent to own. This is very beneficial and lucrative for many investors as one of the best strategy. If you guys have any question, what is your phone number, Matthew? They can reach you.
Oh, you know what? I don't have it on the screen right now, but it's 289-440-2335. So 289-440-2335, and my website, 6 letters, rccsol.com. rccsol.com.
Excellent. And if anyone wants to get hold of me, you can always reach me at 647-407-4049. And thank you for everybody to attend, and I will see you next Wednesday. All the best, and thank you very much.
And if you guys want to learn about tax sales, make sure you ask.
Yeah. All the best.
Okay, take care.
Thank you. Bye.
Goodbye.